Many business owners reach a point where their business is growing, profits are increasing, and opportunities are expanding. At that stage, remaining a sole proprietor may no longer be the most effective structure for your business. In this video, we're going to help you move from sole proprietor to company in Japan by covering the benefits and disadvantages of incorporation, a simple self-evaluation to determine if you're ready, a quick breakdown of the incorporation process, and one of the most overlooked topics, how to properly transfer your assets from yourself to your new company. By the end of this video, you'll have a clear understanding of whether incorporation makes sense for your situation and what steps you'll need to take if you decide to move forward. Let's get started. Incorporation can be a powerful tool for growth, but it isn't the right move for everyone. Before making a decision, it's important to understand both the advantages and disadvantages. First, let's talk about the benefits. One of the biggest advantages is limited liability. As a sole proprietor, you and your business are legally the same entity. If your business incurs debts or faces legal claims, your personal assets may be exposed. Once incorporated, the company becomes a separate legal entity, and in most cases, your liability is limited to your investment in the company. Another benefit depends on your circumstances, as incorporation may help reduce your overall tax burden and create more opportunities for tax planning. When profits increase, corporate taxation becomes more favorable than individual income taxation. You also get paid a director's salary from the company. A portion of salary is deducted, reducing taxable income. This creates a structural tax advantage that does not exist under sole proprietorship. Incorporation also increases your chances of securing contracts and partnerships and makes it easier to do so, as many clients, suppliers, financial institutions, and business partners view incorporated companies as more established and trustworthy. In addition to increased networking, certain government subsidies, grants, and support programs are available only to incorporated entities. Many of Japan's SME support programs, including METI's IT Introduction Subsidy and Business Restructuring Subsidy, require the applicant to be an incorporated entity with a legal presence in Japan. Also, corporations exist independently of any individual. This makes it possible to sell the business, bring in co-owners, or ensure the company continues operating even if the founder steps back. A major driver for switching from sole proprietorship to a company is that the business can continue independently. Now for the disadvantages. Incorporation is an investment as it requires registration fees, legal documentation, and administrative costs. For GK, costs can range from 100,000 yen to 250,000 yen, and for KK, from 450,000 yen to 700,000 yen. Additional professional fees for a judicial scrivener, a notary, KK only, and an accountant further increase the all-in cost. Corporations also owe the per capita corporate inhabitant tax, Kintoa, every year simply for existing, regardless of whether the company made any profit. This fixed annual cost is unavoidable and scales with capital and headcount, meaning a company with 30 million yen in capital will incur a meaningful per capita levy even in a loss year. Social insurance enrollment is required when paying a director's salary or hiring employees. A company that does not pay a salary to a director is not automatically required to enroll. Corporate banking is the critical operational constraint for foreign-owned companies. Requirements include a Japanese national, a permanent resident, a BMV holder, or a spousal visa holder as a representative director. A physical private office is mandatory, and virtual offices are not accepted. Foreign-owned, newly incorporated companies face stricter know your customer requirements than established domestic businesses, and some banks will reject applications outright without Japanese resident guarantor or an established transaction history. Corporations must maintain legally mandated accounting books, file annual financial statements, register changes with the Legal Affairs Bureau within 2 weeks of any officer or address change, and file multiple tax returns with 3 separate authorities. Now that you understand the pros and cons, let's determine whether incorporation is right for you. Pause the video and answer the following questions. Keep track of how many yes and no responses and evaluate based on the scoring system located on the right side of the screen. If you've decided to incorporate, congratulations. The process is more straightforward than many people expect. There are 10 steps. Step 1. Choose your business corporation.
KK's minimum registration fee is 150,000 yen. However, if you need to obtain a business manager visa, BMV, you will need 30 million yen in capital and your registration fee will increase to 200,000 yen.
And KK is a joint stock company, while GK registration fee is 60,000 yen only when the capital is under 10 million yen. For BMV route incorporations with a 30 million yen capital, it is 210,000 yen, and is a limited liability company. Step 2. Get the registration documents ready. 3 major documents needed are 1. Company registration application, the official application form that holds key operational, structural, and legal details about the new company. 2. Articles of incorporation, foundational legal documents filed with a government authority, like a state's Secretary of State, to officially create a corporation. 3. Certificate of seal registration, 3 different seals that you must obtain that represent your corporation, banking, and identity, needed to sign off on official documents. KK companies typically have extra steps and documents. If you're looking for a more detailed description of the application process, feel free to click on this video now. It will also be linked down below in the description. Step 3. Submit your registration application to the Legal Affairs Bureau. The application will be linked in the description. Step 4. Tax registrations must be completed within 2 weeks of the incorporation date. This must be submitted to 3 tax authorities. 1. The National Tax Agency, NTA. 2. Your prefectural tax office. And 3. Your municipal tax office. Step 5. Don't forget to submit your sole proprietorship closure notification, known as the Haigyo Todoke. Steps 6 to 10 are all post-incorporation procedures. Enroll in social insurance, register a payroll office, apply for blue return status, open a corporate bank account, and establish an accounting system. One of the biggest misconceptions about incorporation is that all your business assets automatically become the new company's assets. Your new company is a completely separate legal entity from you as an individual. That means every contract, asset, account, document, and piece of intellectual property must be transferred properly. The first step is creating a checklist of everything your business owns. I recommend organizing everything into 5 major categories: contracts, physical assets, intellectual property, digital assets/online accounts, and invoices/business documents. Let's look at each one. Contracts are often the most valuable assets a sole proprietor owns because they represent ongoing revenue and business relationships. However, when you incorporate, your new company becomes a separate legal entity, meaning existing contracts do not automatically transfer. As a result, you must formally transfer those contractual rights and obligations to the company. In Japan, many service agreements fall under one of 2 civil code categories: a mandate agreement, inin-keiyaku, in which one party performs services on behalf of another, or a contract for work agreement, ukioi-keiyaku, in which payment is tied to the completion of a specific task. Regardless of which category applies, changing the contracting party usually requires the other party's consent. Failing to obtain proper consent could result in the company being unable to enforce the contract. That's why contract transfers should be one of the first items addressed after incorporation. Step 1. Notify clients and suppliers. Before preparing any legal documents, communicate with your clients and suppliers about the upcoming transition. Early communication helps maintain trust and prevents confusion when new invoices or contracts are issued under the company's name. Step 2. Obtain a contract transfer agreement. A contract transfer agreement is the document that formally moves the contractual relationship from you as an individual to your corporation. Many templates are available online, and electronic signature platforms can simplify execution. However, for important contracts or high-value clients, it may be worthwhile to have a lawyer draft or review the document. Step 3. Ensure the contract outline is clear. The transfer agreement should clearly identify the original contract being transferred, the incorporation date, and specify exactly which rights and obligations are being transferred to the corporation. Counterparty consent has to be expressly documented, and the agreement should clarify responsibility for any obligations that arose before the transfer. Step 4. Determine whether stamp tax applies. Certain agreements in Japan may require a revenue stamp under the Stamp Tax Act. Confirm the requirements before execution. Failure to comply can result in penalties and unnecessary administrative issues later. Step 5. Obtain signatures. Once the agreement has been finalized, all relevant parties should sign the document. Depending on the circumstances, electronic signatures may be acceptable, although some organizations may still prefer physical signatures and seals. Step 6. Keep and distribute copies. After signing, provide a copy of the executed agreement to all parties involved. Maintaining organized records is important for future audits. legal inquiries, and internal compliance purposes. Once contracts have been addressed, the next step is to transfer the assets that enable your business to operate. These can include tangible assets such as computers, inventory, and equipment, as well as intangible assets such as trademarks, logos, software, and proprietary business processes. There are three primary methods used in Japan to accomplish this. They are known as sale to the company, contribution in kind, and assignment agreements. A sale to the company, baikaku, is the most common method used by newly incorporated business owners. Under this approach, you sell the asset to your corporation just as you would sell it to any other party. The company either pays you immediately or records the amount as a liability owed to you. Step 1. Determine fair market value. The sale price should reflect the asset's current market value rather than an arbitrary amount. Using a reasonable valuation helps demonstrate that the transaction was conducted fairly and reduces the risk of questions from tax authorities. Step 2. Prepare an asset sale agreement. 是3倍1倍契约者. The asset sale agreement documents the transaction and establishes the terms of the transfer. It should identify the assets being sold, the purchase price, and the effective date of the sale. Having a written agreement protects both you and the company by creating a clear record of ownership. Step 3. Issue a sales invoice. Issuing an invoice provides evidence that the sale occurred and supports the accounting treatment of the transaction. If the transaction falls under Japan's qualified invoice system requirements, the invoice should contain all necessary information. Step 4. Record the transaction. The company should record the acquired asset and any payment obligation in its accounting system. This ensures the asset appears on the company's balance sheet and can be depreciated if applicable. Proper bookkeeping is essential for tax compliance and financial reporting. A contribution in kind, also known as genbutsu shushi, allows you to contribute property instead of cash. You receive shares or ownership interests representing the value of the property contributed. This approach is often useful when valuable equipment or machinery is needed to launch operations. Unlike a sale, a contribution in kind must generally be planned before incorporation is completed. The contributed assets need to be identified in the Articles of Incorporation because they form part of the company's initial capital structure. Step 1. Declare the contribution. The contribution must be described in the Articles of Incorporation, including details about the asset and its value. This information allows authorities and stakeholders to understand how the company's capital was formed. Step 2. Court inspector appointment and report. In some situations, an independent inspector may need to verify the value of the contributed property. This helps protect future shareholders and creditors from inflated valuations. Certain exceptions exist, particularly for smaller contributions or property that has already been professionally valued. Step 3. Register the contribution. Once the contribution has been completed and any required reports obtained, the information must be submitted during the registration process. The Legal Affairs Bureau will review the documentation as part of the incorporation filing. Proper registration formally recognizes the asset as company property. An assignment agreement known as jotokeyaku is commonly used to transfer legal rights rather than physical property. This method is particularly useful for intellectual property, receivables, and other intangible assets. Step 1. Identify the asset and legal owner. Begin by clearly identifying the asset being transferred and confirming ownership. For intellectual property, this may involve registration numbers, copyrights, trademarks, or patents. For receivables, it may involve identifying the debtor and the outstanding balance. Step 2. Prepare the assignment agreement. The agreement should specify the asset being transferred and clearly state that ownership is moving to the corporation. It should also include the transfer date and any consideration being provided. This is particularly important for valuable intellectual property. Step 3. Notify third parties where required. Some assignments require notice to third parties before they become fully effective. For example, debtors may need to be informed when accounts receivable are assigned. Certain intellectual property registrations may also require updates with government authorities. Step 4. Record the asset. After the transfer is complete, the asset should be recorded in the company's books at its agreed value. Proper accounting treatment ensures that the company can accurately report its assets and financial position. Digital asset transfers are often complicated because two separate transfers occur simultaneously. The internal transfer occurs between you and your new corporation from a legal ownership perspective. The internal transfer is the legal transfer between you as an individual and your newly incorporated company. This is typically accomplished through an assignment agreement that clearly states which digital assets are being transferred and when ownership changes. The external transfer occurs with the platform provider itself, which may have its own requirements, restrictions, and approval procedures. The external transfer requires updating the records maintained by the platform provider. The platform's terms of service typically determine who the account owner is. If those records are not updated, the company may have difficulty proving ownership later. Step 1. Complete the legal transfer. The legal transfer should always be completed first. This establishes the company's ownership rights before any external changes are attempted and creates documentation that may be required by certain providers when processing ownership updates. Step 2. Review platform policies. Before submitting transfer requests, review each platform's terms of service and ownership policies. Some providers allow ownership transfers, while others require accounts to remain under the original registrant. In some situations, entirely new corporate accounts may need to be created. Step 3. Transfer domain names. Domain names are often registered in the founder's personal name and must be updated to reflect the corporation. Most registrars have a formal transfer or registrant update process. This typically involves updating ownership information, contact details, and administrative records. Step 4. Transfer or recreate platform accounts. If a platform permits ownership changes, update the legal entity information, billing information, and account ownership records. If ownership transfers are prohibited, create a new corporate account and migrate the data before closing the personal account. To provide an example, I will discuss the procedure of transferring websites. Step 1. Inventory every website component. Begin by identifying every component associated with the website. Many business owners focus only on the domain name and forget about hosting accounts, source code repositories, or third-party integrations. Step 2. Execute a website and content assignment agreement. The assignment agreement should clearly state that ownership of the website and all related assets is transferring to the company. This includes all associated content to the website, graphics, code, and intellectual property rights. Step 3. Transfer the domain name and hosting account. The domain registrar and hosting provider should be updated to reflect the corporation as the new owner. This typically requires updating the registrant information, contact information, billing details, and administrative access credentials. Once completed, the company becomes the recognized owner of the website infrastructure. Step 4. Transfer copyright of content. The company should own all original content appearing on the website, including articles, images, videos, and downloadable resources. Copyright ownership should be specifically addressed in the assignment agreement to ensure the corporation can legally use, modify, and monetize the content. Step 5. Update the privacy policy. Privacy policies often identify the legal entity responsible for collecting and processing personal information. After incorporation, references to the sole proprietor should be replaced with the corporation. This helps maintain compliance and accurately informs users about who controls their data. Step 6. Update the terms and conditions. Terms and conditions should also be revised to reflect the corporation as the website operator. Customers need to know which legal entity they are contracting with when purchasing products or services, and that completes the process. Once the operational assets have been transferred, attention should shift to customer-facing financial documents. Invoices are particularly important because they directly affect payments, tax reporting, and compliance obligations. The first change should be to move the business name to the top of the invoice. The corporation's legal name should replace the sole proprietor's name on all templates and billing systems. This ensures customers understand which entity is providing the goods or services. It also reinforces the corporation's independent legal status. Any registration numbers associated with the sole proprietorship should be removed and replaced with the company's registration information. If the corporation is registered as a qualified invoice issuer, the company's registration number should appear on all invoices. This is particularly important for customers who need the information for consumption tax purposes. Customers should be instructed to send all future payments to the corporation rather than to personal accounts. Bank account information, payment processor details, and billing instructions should all be updated. The final stage of the transition involves updating every document that represents your business. Although this may seem like a branding exercise, it also has important legal implications. Consistent use of the corporate identity helps reinforce the company's status as a separate legal entity. Inconsistencies can create confusion for customers, suppliers, and government agencies. The corporation's legal name should appear consistently across all contracts, proposals, templates, and marketing materials. Using the correct legal name reduces the risk of contractual disputes and helps maintain limited liability protections. If the company is adopting a new logo, it should be implemented across all materials simultaneously. This includes websites, invoices, email signatures, social media profiles, and printed documents. Consistent branding helps customers recognize the business and reinforces the transition to the new corporate entity. Corporate tax identification details should be incorporated into standard forms, invoices, contracts, and purchasing documents. This ensures accurate reporting and reduces administrative errors. Customers, suppliers, and accounting professionals often rely on these identifiers when processing transactions. Business addresses, telephone numbers, email addresses, billing contacts, and website footers should all be reviewed and updated. Any references to personal contact information that no longer apply should be removed. Consistent contact information makes it easier for customers and suppliers to communicate with the company. Incorporation can provide stronger legal protection, tax planning opportunities, greater credibility, and long-term growth potential. However, it also introduces new costs, responsibilities, and administrative requirements. Before making the transition, evaluate your readiness carefully, understand the incorporation process, and understand how to transfer your assets properly. If you're considering incorporation in Japan and would like professional guidance, feel free to sign up for our 30-minute free consultation in the link below. We will also link more resources in the description. Thanks for watching, and we'll see you in the next video.